All right. This is The Earth and Its Peoples by Richard Bulliet, Chapter 19, The Atlantic System in Africa, 1550 to 1800. We'll look at Section 3, Creating the Atlantic Economy. So first, we get a really good map in Section 3 for really illustrating what exactly the Atlantic System is. So when we look at this map, this body of water is the Atlantic Ocean. Right, here's the North Atlantic. Here is the South Atlantic. And the Atlantic System is the surrounding connections and interactions that occur all throughout this particular region. It is the combination of Europe on the one hand, Africa on the other, and then the Americas on the other hand, whether it's South America, North America, or very important, these Caribbean islands right here. So you get sort of a much better feel for what this Atlantic system looks like from this particular map. One of the very important things to the system, of course, was the economy. Now, nations who participated in this Atlantic system followed certain economic theories and rules, you might say. Capitalism and mercantilism, these are both different, what we might call economic systems. The way to kind of think about it is that for the most part, many of these nations were strongly mercantilist first and then switched over to a more capitalist system. Capitalism, there's a lot of different ways that you can define capitalism. For the most part, it means individuals determine the market, and by market we generally mean, and this is the true for any market, buyers and sellers. So what to sell, what to buy, what price to put it at in a capitalist system, that is mostly done by individuals. However, there are also specific institutions that are a good indicator of a capitalist system. And from 1550 through 1800, in Europe especially, and all around the Atlantic system, it was this emerging capitalist system. So as time went on, you might say that this system became increasingly capitalist. Banks, of course, banks are important as not only a store, but also a lender of money. Very important feature of a capitalist system is credit. The ability to lend out money and then get it back, charging interest. Banks existed in Europe prior to this Atlantic system, prior to Christopher Columbus, but were really only used for the local economy. Many of those banks then became investors in a lot of these trading ventures overseas. Stocks are very important. Joint stock companies, these things are one and the same. I'll go ahead and describe both of them. A joint stock company essentially is what we might identify as a modern day corporation. It is essentially a business that allows the pooling of capital. And if we think back to the voyage of Christopher Columbus, his 3 ships, funded by the King and Queen of Spain, the Nina, the Pinta, and the Santa Maria, was funded essentially by one individual donor, you might say, or patron or investor, whatever term that you want to use. This was very difficult to do because not everybody in Europe had enough money to finance these voyages or finance these economic ventures. And what joint stock companies did was, instead of relying on just one single person, you get a group of investors, right? You get many investors. You get a joint effort by lots of different people who then chip in a little bit of money, right, into this venture. That way the business can finance things like the shipping, the crew, maybe even plantations if there's plantations involved. And the idea is that if that business makes money, then so does the investors, or What they're really called are the stockholders, because in exchange for financing a company, each individual person who financed it gets a stock, right? And this is a way for individual investors to be part of a company. So we might say for stocks, allowed for easier and more investment, right? Easier and more investment. Lastly, you had assurance, especially commerce insurance. This could make trade less risky. So people were more willing to invest in companies because there was commerce. And what all of these things did was really to help increase trade. And the ones who were really good, at least early on in this capitalist system, was the countries of England and the Netherlands. All right, Netherlands. However, Europe's economy, and really the economy of the Atlantic system, is through these decades and centuries sort of slowly transitioning into this capitalist system. A lot of the institutions existed, which made it a lot easier for the system to unravel. But for the most part, when it came to determining and deciding economic policy, most countries were adhered to this idea of mercantilism. So mercantilism, like I said before, is an economic system, like we wrote up here. But rather than individuals determining really the market, buying and selling, in a mercantilist system, individuals could still determine the market, buyers and sellers. However, there is often a lot more government intervention, at least in the way of rules, policies, and laws. But what mercantilism is, it's an economic theory that states wealth is finite, right? Whereas in a capitalist system, generally speaking, in a capitalist system, you might say that wealth can grow, right? Wealth can grow. And so I'll illustrate this point here for it to make a little bit more sense. So in a mercantilist system, if we add up all of the wealth in the world, and typically wealth was determined in those days in gold and silver. And so if you think along these lines, there's only so much gold and silver in the world, and it's divided up between the various European powers, right? This is a pie chart. Maybe this is Spain because Spain became very rich from the New World. This might be Portugal. Portugal was also very rich early on. And in a mercantilist system, in order for one to grow their slice of the pie, right? If Spain wants to become richer, it means that one of these other countries must become poorer. In other words, economics is zero sum. Whereas in a capitalist system, capitalists would say, look, this pie can grow. You can actually grow wealth through free trade, through interaction, through commerce, etc., etc. And so what this mercantilist system really translated to was, in some cases, very strict economic competition. Because wealth was believed to be zero sum, under a mercantilist system, trade with other nations was discouraged. In other words, nations didn't want to trade with one another, and instead countries chartered various companies. And what a chartered company is, examples are the Dutch East India Company and Dutch West India Company, or the British Royal African Company. Chartered companies are companies with government privileges, right? And probably one of the most common ones was monopoly. So for example, in this model, in the model of a mercantilist system where wealth is zero sum, countries had an incentive to try and hoard all the wealth. And what these nations wanted to do was to prevent any internal competition. The Dutch wanted to make sure that the Netherlands could get as much wealth as possible and that their own companies weren't competing with one another. The British wanted to make sure that the Royal African Company, for example, didn't compete with any other English slave trading companies. And so both of them were granted special privileges. Monopoly means that no other internal competition can exist. Britain and France and the Dutch and the Spanish, they all competed with each other, but these chartered companies never competed with other companies from their own nation. It was very, very nationalistic, and that's really one of the reasons why colonization in this period was so intense, because, let's say that England wanted to get silver, right? We already know from last chapter that Spain discovered a lot of silver in the New World, but they're not willing to trade it. And so if France wants silver, they either have to go find a colony of their own to discover it and mine it, or they have to go to war with Spain and take over their silver because there simply is no trading going on. So a lot of the Atlantic world was gobbled up very quickly in this highly competitive nationalistic economic race. Like I mentioned before, the system of mercantilism eventually gave way to this system of capitalism, where some of these charters were eventually revoked and more competition was allowed into the market. One prime and perfect example of mercantilist policy at work was the Navigation Acts. The Navigation Acts were a set of laws that restricted trade in England's 13 colonies. All right. In other words, this was a law that required the English colonists in North America to only trade with England and forbid them from really trading with anything else or anyone else. This is also one of the long-term causes of the American Revolution. The Atlantic Circuit, like we looked at this map previously, the circuit, we might just refer to this as the various interactions that occurred across the Atlantic Ocean. We can see all sorts of different ways in which goods and people traveled in this area. A couple of terms that we want to be familiar with: Middle Passage. Middle Passage was the voyage slaves took from Africa to the New World. So if we look at our map, the Middle Passage would be indicated essentially by some of the yellow, especially these two parts here. Maybe I'll go ahead and get, let's get orange here, right? So this, slaves going to Brazil, slaves going to the Caribbean. That would include what the Middle Passage is. We sometimes also describe this Atlantic system with another term called the triangle trade. This would be trade. It could be used to describe more or less any sort of three legs of this trade, but mostly we're talking about Americas, Europe, and Africa. It could also include, for example, right here, North America, and the way in which all of these different parts of the economy were reliant upon one another. So for example, let's just take sugar. When it came to sugar production, sugar for the most part was grown in the Caribbean, right? This is where sugar would have been grown. However, the labor that was required to grow sugar typically came from Africa, so that might be one leg of the trade. And then once the sugar was harvested, it would either go to North America to manufacture, or it would go to Europe for manufacturing. And then once it was processed, especially in North America, processed into something like rum, it might go back to either Europe or go back to Africa. Same thing with Europe. It could go back to Africa to be a manufactured good, alcohol, which was sold in order for the slave trade. So any three legs of this triangular system, we could characterize it as the triangle trade, and it's a term that you might come across pretty frequently. Of course, a very important part of this in the development of world history is the slave trade, not just economically speaking, but also in terms of the political and culture and social history, especially in some of the areas where you see on this map that are in red. The ones that are in red were main areas of importation of slaves, the Caribbean, places of Brazil down here as well. In terms of looking at the volume, we could say that the volume increased significantly after 1600. For the most part, it was, if you had looked at a graph at the number of slaves that were brought to the New World, it might look something like that. Then you get to about the year 1800, and then it begins to drop off after that point, but certainly accelerating like an exponential graph. And a lot of the reason for that was because of things like sugar, which was incredibly profitable. In terms of the nations who participated in it, we could say that England, we might also add the Dutch to this, accounted for approximately 40% of the slave trade, France 20%, Portugal 30%, and North America only 3%. So it's important to understand, and we can see this from this map, and this is especially true because most of us listening to this right now are kind of more familiar with the version of slavery in the United States. But if we take a step back and look at the global perspective, we'll notice that when it came to the whole Atlantic slave trade from 1500 to 1800, it is primarily one from a region of Central Africa to the Caribbean, this would be kind of Western Central Africa right here to the Caribbean. It would then be from Central Africa to Brazil, which the second largest number of slaves were taken. It would be to other West Indies islands, and then only maybe 3% being brought to North America. And then when in North America, all of those slaves would have ended up mostly on the southern colonies. The slave trade itself was absolutely brutal. The Middle Passage was abysmal. The way in which one can characterize the slave trade is, one, mortality. So anywhere between, we'll just say about 25% of slaves died on the Middle Passage. That was just the voyage that was taken. People were chained down in very unsanitary conditions. Disease was the primary killer in that area. Sometimes slaves mutinied. To mutiny means to fight back. And something that slave drivers called fixed melancholy, which was hunger strikes. And slaves resisted the entire way from the shores of Africa along the ship to the New World. And then when they came on some of those plantations, which we talked about last section, continued resistance was in various forms as well.